Right now, you've got a lot of questions concerning your finances, but there are no answers in sight. For instance, you're making a lot of sales, you see a lot of money coming in, 100,000 rand, 200,000 rand, or more. But come next week, you are unable to pay the rent for your premises. Then the question is, what is happening? The problem really isn't about income. The problem is a broken cash flow. In this video, I'm going to show you how to use a simple cash flow projection to regain control and to begin growing your business sustainably. Hi, I'm Kenneth Phiri from Phiri Consulting, where we help entrepreneurs like you build scalable, sustainable, profitable, and fundable businesses. Now, if you're new here, please do consider subscription to the channel. Also, like the video and share it with some people that you know that are venturing into entrepreneurship. Now, please also stay tuned because later I'm giving away a free template that you can use to develop your own cash flow. So please do stay tuned. Also hit the notification button so that you don't miss out to any goodies that we are bringing your way in this season. Now, first and foremost, a lot of entrepreneurs always confuse revenue with sustainability or stability. Now, there are cases where you can be really making a good income coming in. You can even be profitable, but at the end of the day, fail to actually meet some of the obligations on time. The key here is meeting your obligations on time. For instance, you can have your income coming from clients, but they are paying late. But the reverse or the opposite of that, you find suppliers demanding payments upfront. So in that scenario, the issue there is a cash flow issue, not necessarily a revenue or income issue. So exactly what is cash flow? Now, cash flow is the timing. Again, I repeat, cash flow is the timing of money coming in versus the money that is going out. Now, when we say timing, which means there is a specific timing when money is expected to come in or to go out. Now, oftentimes there is misalignment in terms of cash flow. Now, because of that misalignment, then we've got serious issues in cash flow. And then another biggest problem as far as cash flow projection is concerned is that a lot of entrepreneurs fail to distinguish it from revenue as well as profit. Now, when you're talking revenue, you're looking at all the income that is coming in from different income sources that you might be having. Maybe you've got a tangible product that you're selling to market. You've got a service that you're offering. You've got multiple properties and you earn rent. So you've got rent income. So you are calculating and adding all the income that is coming into that particular business. Now, this makes what is called your revenue. Okay. Now that you have revenue, then we can now start moving toward profit because profit is a component that is found in revenue. So to get profit, it means that first and foremost, you need to take into consideration all your costs, fixed costs, variable costs, and then subtract this from your revenue, thereby giving us a scenario where we say profit is equals to revenue minus cost. So if you are now successful in removing all those costs from the revenue, then you've got your profit. Now, this figure can either be positive or negative. If it is negative, it means that you're making a loss. If it is positive, it means that you're making a profit. So please make sure that you are able to differentiate cash flow from revenue and income. Okay, now why do funders or banks love a business that has got a strong cash flow projection? Now, the number one reason is viability, to see whether the idea, the product, when it goes to market, is it a viable business idea or is it a viable business? Is it able, number two, to sustain itself? So viability will always give birth to sustainability. Is it just a one-season product, a one-hit wonder, or is it going to last in different seasons, in different markets and so forth? So The second part is sustainability. And then the third part is the ability to finance debt. Now, here we're looking at your amortization, or you're looking at your ability to pay debts from the profits or the income that you've made. Remember that some of this funding that you're going to get is going to be uh, payable back. If you're paying back, then there's interest attached to it. If there's interest attached to it, how much cash are you making, maybe per month or in a particular time frame, to give you that ability or the flexibility that you need in order to pay back those particular debts. So always make sure that you create a very good cash flow projection, which will show these three key things, which is viability, sustainability, and ability to pay debts. Then how do we build a simple cash flow? Now, there are so many ways in which you do that, but I've found that the simpler you do it, the better it is. One, to understand for the people that are involved and for yourself, and you can also teach this to someone else. Now, these are the a few steps that I always prefer, and this is exactly what we are going to use as we go into the scenario or the example that we're going to use. Now, the first thing that you must do is to make sure that in your particular cash flow, you start with the beginning balance. Now, in that beginning balance, you're looking at the money that you're starting with, all right? And then you add the second thing, which is you add income, and this is by an expected date. It is very important that you highlight the date there that this income is expected to come in. And then number three, you subtract fixed and variable expenses by the actual date when they are due. All right. Make sure that the due date is clear there. And then number four, show the flow by week or by month. Okay. So now let's look at this scenario and break down exactly by entering into these sheets and see exactly how you can create your very own. Please follow through. In our example here, we're going to look at a small service, a business. In this, we're going to try and figure out what will be the cash projection. As you can see here, both July, August, and then we would September. All right. Let me just fix that here. September there. All right, just short for September. All right, so I say that in the instructions that always start with the opening balance. Now, this is the amount of money that you have at the beginning of the period. That is your opening balance. So for our sakes here, let's say, for instance, this business has got an opening balance. It is you started, you've been saving, you only have got 1,000. In case of emergency, something happens, you've got a 1,000 dollars, it could be 1,000 rand or so forth, right? Over and above this amount that you have, you need then to add the income. Now, because you just started, you have landed 3 clients, as you can see here. You have landed 3 clients. Each of those clients for digital marketing services is paying you 5,500. You've got a fixed rate. Each client pays you this much for the work that you're doing for them. So these 3 here times the number of clients will give you a total income here of 16,500. Okay. Now the 16,500, I'm getting it from the fact that I just multiplied 3 times 5,500. It gives you amount there. Okay. If we take then this 1,000 plus the 16,000 that we have here, then we are going to have a total in terms of the revenue or the income that this business has. 1,000 plus this 16,500 will get a 17,500. So we're expecting that at the end of July, if the clients are paying on time by the last date of July, which is July the 31st, then we are going to be having this amount. This 17,500 is coming from the amount collected and this balance. Okay, so that's the total income. Okay, now we need to go to expenses. I said previously that expenses must be separated into fixed expenses and variable expenses here. Now, the fixed expenses are all those expenses that do not change maybe in one calendar period. Okay. For instance, your rent here is going to be the same. Okay. Your rent from month to month to month for that particular year, unless otherwise noted, you always know when your increase is expected. So, for this business, let's assume that the rent is 2,000. Okay, you're paying a 2,000 rental, but you've also decided to give yourself a salary of 10,000. Okay, that's your salary. And then because you are running an online business, you are expected to have Wi-Fi, maybe it's on contract, and then it's on a month-to-month basis. Then you're paying 500 for that Wi-Fi. It could be Rain, it could be Vodacom, MTN, whatever the case might be. The assumption is that you're paying 500 for that Wi-Fi. So if we then look, and then we've got these fixed expenses, your rent, you've got salary, and then you've got Wi-Fi. Now we need to go down to variable expenses. The variable expenses are expenses that are going to change based on time, right? Or based actually on usage. For instance, you're going to be calling a lot of clients here in order to secure appointments. Let's say in this case, you're going to spend 600 on phone. And then the office is small. You don't use much water and electricity, and you're working alone. So you're going to spend 400 there per month. Okay. Now, if we check then all the expenses, the fixed costs and the variable expenses are going to give us the total expenses. Let us calculate together. You've got 2,000 plus 10,000. This is 12,500 up to a fixed cost, right? And then you add this 6 plus 4 is 1,000. So you will have a total here of 13,500. Okay. So 13,500 is your total expense bill that is expected by the end of the month. But we're also expecting that we're going to get this income, which is 17,500. So if you get your income minus expenses will give us the closing balance here. So this is 17,500 minus 13,500. This will give us an amount of 4,000. So 4,000 now is our closing balance. Let's see if we can be able to highlight it. Okay, so we've got 4,000. This is the end of July. So in July alone, the total income or revenue was 17,500. And then the total expenses came to 13,500. The difference between those two gave us a closing balance of 4,000. So we're going to check this 4,000. This becomes the opening balance for August, right? August, so we've got 4,000 as an opening balance. All right. Now let's assume that you did not get any new clients. If you didn't get any new clients, you are still charging these clients the same amount, no increase. So in August, you're still going to raise 16,500. All right. But the total here, because the opening balance was high, the total comes to 20,500. And okay, so you've got a total revenue or total income of 20,500. As I mentioned here, the fixed costs will remain the same. So you've got rent remaining at 2,000. And then your salary, let's assume that you didn't give yourself a bump in salary. Okay. So again, you still have got 10,000. Your Wi-Fi, your service provider did not change. Okay. So you still have got 500. Okay. But when it comes to your phone, you decided, you know what? You want to increase your client base, and then you spent a little bit more on phone from 600 to 1,000. And then on this one here, Water, electricity, because you're spending more time in the office, you spend 100 rand more now, you're at 500. Okay, you'll see then that your expenses have increased by an additional 1,000. Here, let's see, additional 500. This 2,000 plus that is 12,500. 13,000, 14,000. So the total expenses for August then comes to 14,000. All right. Okay. Let us highlight that. Okay. We've got a 14,000 there. And then you've got income was 20,500 minus the 14,000. Okay. 20,500 minus 14,000. This will give us, I think, 6,500. Please correct my maths if someone is wrong. Okay, yeah, 500 extra for 6 years is 6,500. Now, this is the balance carried down. It's going to be carried down to September. So you come to September again, you've got 6,500. Okay, so that's the opening balance. Then you'll do the same thing here. You'll see that with time, either if expenses bulge up, your balance will be less, or if income increases, your balance is going to be more. So then you're able to plan accordingly there, whether if you're getting more money or not. But one thing of note is that you need to make sure that you cover all the income. If maybe additional income comes in, you start making other things, maybe you start creating business plans and so forth. You need to include these under your revenue, and then which means this will change here. And also when it comes to expenses, if there are any other additional expenses, stationery, so forth, you're making some purchases, it means that your bill will change as far as expenses are concerned. Then you need to categorize them under either fixed expenses or variable expenses, and this will change the total expenses and will affect the balance. If the total expenses are more than the revenue, then we'll end up having a negative balance here. And whatever balance we get is the balance that we carry over to the new month, which becomes the opening balance for the new month. In our case here, the balance closing for August was 6,500, which is the opening balance for September. Again, I need to reiterate this, that there must be timelines here. You need to, if you're using on a week-to-week basis, you need to state exactly week 1, what is the expected date for this income to come in, and then what is the expected date for you to pay these bills as far as expenses are concerned. If it's on a month-to-month basis, the date also need to be highlighted so that you can plan. You cannot plan outside of time. Planning is done within specific time frames. So make sure that that is dealt with appropriately. So you continue doing that and that. Now, I've included a template for the cash flow projections in the description down below. Please make sure that you download that template and also leave any comments and leave any answers if there are any such answers. Okay, let's continue with the video. Now, to get you started, I have built this is your cash flow projection template that you can use. It's basically plug and play. You can just fill in according to your experience, according to what is happening in your business, according to your own figures. But it's basically simple and it's free, and you can start working on it right now. So just download it. I'll leave the link down below, or just DM me, Flo, and I'll send it directly to you. And this template has been created with you in mind because it's for SMEs just like yours. So don't just guess, you need to project it. Now, also make sure that you do subscribe to the channel so that you follow through all the other financial tools that we are going to be dealing with in this particular series. Next week, we're going to be looking at how you can break down your income statement like a CEO or like a chief financial officer and find out exactly what each of those columns, each of those figures, whatever a breakdown we're going to do mean to you, mean for your business, and how you can use them to plan in the future and so forth. Remember, all these tools are to make sure that your business performs well financially, because financial performance is one of the most important aspects to measure whether a business is doing well or it's not. And again, it is critical for you to grow that particular business. So please stay tuned to the channel. Make sure you like, you subscribe, and also hit that notification button so that you don't miss out on all the things that we're bringing to you in order to make your business grow faster and smarter. Otherwise, remember also that early preparation equals excellent results. This is Phiri Consulting. We'll see you in the next video. Bye.